Hello, my name is Mike Sinibaldi, and welcome to this week's video edition of Heard on the Street. In this edition, I'm going to take a look at the following markets: the Dow Jones Industrial Average and the S&P 500. The first market that I'm going to take a look at is the Dow Jones Industrial Average, more specifically, the big picture that may be used as an analogy for future price movement. At the yearly chart level, three key observations can be made. First, I've labeled the chart with a long-term wave structure dating back to 1920, where Grand Supercycle 3 has completed and Wave 4 is unfolding. Other practitioners have Wave 3 circle, or the Grand Supercycle top, here instead. Either interpretation agrees that cycle wave A ended at 6470. If my labeling is correct, then according to Elliott Wave International, Grand Supercycle Wave 2 unfolded as a zigzag, not shown due to the lack of data, between 1720 to 1784. Then Grand Supercycle Wave 4 should unfold as a triangle or a flat due to the rules of alternation. Corrective patterns typically terminate at the previous fourth wave, especially when they are fourth waves themselves. Should this be the case, an absurd target of 570 exists. But let's not get carried away here with theory. I merely want to show readers how Elliott Wave is applied and remain focused on one wave at a time. Number 2, I have also added the yearly pivot point to the chart, expressed as a moving average. For 2011, the pivot is 10,938. Notice that every time the Dow traded below its yearly pivot, bear markets occurred, as in 1929 to 32, 1973 to 74, 2000 to 2002, and 2008 to 2009. As I mentioned, the 2011 pivot is 10,938. If the market retraces 0.382 by year's end, this would be a reasonable correction. Will then be below the 2011 pivot and as well as 12,127, the 2012 pivot. That could prove to be the tipping point to another crash based upon the history of the market. The 2-4 supercycle trend line extends to 4741 by December 31st of 2012. While this level seems miles away, one only needs to look at what transpired in 2009 to see the possibility of such an event. A break of the 2-4 trend line would be very bearish. Here, the yearly chart level has been transposed onto the quarterly chart. Notice that Grand Supercycle 3 terminated with a classic momentum divergence where price continued to rise as momentum fall. If cycle wave B is complete, then wave C equals wave A at 5147. Notice that the 2-4 trend line from the yearly chart intersects this key level. Should the market need one more push to the upside to complete wave B, the implications are same, just a lower target changes. Now that I have provided the analogy for market movement, let's see if we can find some similarities between the Dow and the S&P. At the weekly chart level of the SPX, as measured by DIF, shows that the market can make further declines before support is reached. Sticking with that thought, the running triangle alternative has been eliminated because wave C of triangles should equal 0.618 of wave B when wave B is greater than wave A. Additional evidence that price will continue to decline can be seen by looking at the Russell and Value Line charts, which are within a few points of their wave A lows. The S&P is lagging, but should play catch-up within the coming weeks. Last week I presented this chart of the E-mini S&P where the market is in need of one more recovery high to complete wave B and wave 4 is unfolding as a flat. However, if the Dow analogy is our guide, Wave B terminated at 1367 1/4, and a new high will not occur. The beauty of both interpretations is that each calls for significantly lower prices in a 5-way decline. The market is a stone's throw away from testing the all-important 1241 to 1246 support level and the 50-period simple moving average. This is a significant area, so I'll be looking for that level to hold on the first test before continuing lower. Finally, the front month contract has rolled and the lead month is now September. Notice that I'm still working either the expanded flat or the cycle wave B top. I've updated how I anticipate the wave structure to unfold based upon the contract roll. The levels are self-explanatory and are consistent with the Dow analogy. The market will either complete wave 4 and then make a new recovery high, or complete wave 1 of a multi-year bear market that is resumed. I hope you found this video helpful, and best of trading.